In the year 2000, Enron was named America's most innovative company. 16 months later, it filed the biggest bankruptcy in United States history. 20,000 people lost their jobs. Retirements evaporated. Shareholders lost $74 billion. And here is the part that should keep you up at night. The fraud wasn't locked in a shredder. It wasn't buried in offshore accounts. It was printed in the annual report in black and white. And if you knew what to look for, you could see the money disappearing in real time. Today, we're going to trace exactly how Enron used something called special purpose entities, or SPEs, to turn debt into fake revenue. We'll look at the one financial chart that told the whole story 6 months before the collapse, and by the end, you'll understand why this wasn't just a crime of greed, it was a crime of optics. Enron started as a legitimate energy company in 1985. Natural gas pipelines, physical infrastructure, a boring but profitable business. But in 1990, they hired a consultant named Jeff Skilling, and Skilling had an idea that sounded brilliant. Enron wouldn't just sell energy, it would trade it, like stocks or commodities. The problem was that trading is risky. You can win big or you can lose big, and if you report a loss, your stock price tanks. So Skilling introduced something called mark-to-market accounting. Here's how that works. Let's say Enron signs a contract to deliver energy 10 years from now. Under mark-to-market accounting, they don't wait 10 years. They estimate the total profit of that deal today and book it as revenue immediately. Never mind that the deal might fall apart. Never mind that they haven't collected a dime. On paper, Enron just made $100 million. And because they were making money on paper, the stock price soared from under $10 in 1990 to $90 by the summer of 2000. But here's the catch. All that fake revenue required real cash. Enron had to build power plants, buy bandwidth, and invest in international projects. And because their credit rating was everything, they couldn't let the balance sheet look heavy with debt. So they found a loophole so elegant that their own chief financial officer, Andrew Fastow, won awards for it. They created ghost companies, special purpose entities, companies that existed only on paper. Enron would transfer its debt into these SPEs, and because of a technical accounting rule, if outside investors owned just 3% of the entity, Enron didn't have to list the debt on its own books. Let me say that again. Enron moved $38 billion of obligations into these side companies, and because 3% of the funding came from so-called outside investors, the debt vanished. It was technically legal. It was practically magic. But who were these outside investors? In many cases, they were Enron's own executives. Andrew Fastow personally controlled some of them. He made millions managing the very entities that were hiding Enron's debt. He was simultaneously the CFO of Enron and the owner of its debt. Now this brings us to the chart. The one chart that explained everything. In 1999 and 2000, Enron's reported net income was climbing rapidly, but their cash from operations, the actual money hitting their bank account, was flat. In some quarters, it was negative. Any forensic accountant will tell you that when a company's reported profits and its actual cash flow diverge like that, something is very wrong. Profit is an opinion, cash is a fact. Wall Street analysts saw this chart. The SEC had access to the filings, but nobody asked the hard question because Enron was the golden goose. The stock was everybody's favorite, and questioning the goose felt like leaving money on the table. Then in August 2001, something changed. Jeff Skilling resigned as CEO after just 6 months on the job. He claimed personal reasons, but insiders knew he was jumping from a plane he had already rigged to crash. That resignation triggered a closer look. In October, Enron announced a $600 million third-quarter loss. They admitted that they had been hiding debt since 1997. The SPEs unraveled. The stock fell from $90 to under $1 in 6 weeks. And here's the final irony. When Enron filed for bankruptcy in December 2001, the assets they actually owned, the physical pipelines, the buildings, the infrastructure, were worth far less than the paper profits they had invented. The company was a shell wrapped around a spreadsheet. The crime wasn't complex, it was hidden in plain sight, in the footnotes. Andrew Fastow eventually pleaded guilty to securities fraud and served 5 years. Jeff Skilling was convicted and served 12. But the forensic trail they left behind became the textbook example of how to spot corporate ghosts. So the next time you see a company posting record profits while their cash flow stays flat, remember the SPEs, remember the 38 billion, and remember the most dangerous frauds don't hide in the dark. They hide in the footnotes under fluorescent lights, dressed up as innovation.